Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So, I'm not very much fun to watch hockey with, or so I've been told. And I gotta confess, I do ride the emotional roller coaster. I can go from, this team is so awesome, we're going to win the Stanley Cup, to, oh my gosh, this team sucks, we're never going to win another game, in the span of about one goal. And I think a lot of people out there in the mainstream kind of approach investing in the same way. I mean, they can swing from mega bull to mega bear on the power of one little post on X. So, with it now looking like we may not have a protracted trade war and Trump's aggressive negotiating strategy might be bearing fruit, we're starting to see a bit of mainstream bearishness surrounding gold. After all, tariffs were absolutely the only problem on the economic horizon. So hopefully your sarcasm meter just pegged out. But can you really blame market analysts? I mean, it's been all tariffs all the time for months. And it stands to reason if that problem is looming less large, there would be an exhale of relief and a sense of optimism. And I'm definitely seeing that in some of the financial news commentary out there. And with the tariff storm maybe calming, I mean, at least it kind of seems to be, it's no wonder that people are becoming more bullish on the trajectory of the economy and therefore on the stock market. On the flip side, gold is getting pushed to the curb. I mean, there's no need for a safe haven, is there? I mean, if there's not anything to hide from, right? So last week, Citigroup lowered its gold forecast, projecting that the yellow metal would fall below $3,000 an ounce by the end of the year. And Citi is by far, I think, the most prominent kind of bearish turn towards gold that I've seen. But there are other mainstream voices out there that are kind of starting to raise the caution flag when it comes to gold's incredible run that we've seen over the last 18 months or so. The Citi analysts cited easing geopolitical tensions, diminishing gold's safe haven appeal, and they also hold a pretty sanguine view on the direction of the economy, saying there is a growing sense that the economy can avoid a recession and that inflationary pressures will remain contained. So in other words, Jerome Powell's stagflation worries that he's expressed, Citi says, no way. Quote, we see investment demand for gold abating in late 2025 and 2026, as ultimately we see President Trump's popularity and U.S. growth put kicking in, especially as the U.S. midterms come into focus, end quote. So, as I've already alluded to, much of Citi's optimism seems to hinge on a resolution of the trade war. Tariff worries have driven both higher inflation expectations and worries about a looming recession. And it is quite possible that President Trump could successfully negotiate an end to the excessively high tariffs. And that seems to be the strategy, right? I mean, it seems like almost every day we hear, oh, this tariff is being put off, or, we're going to give them 90 days to negotiate it. So this is the strategy. And I think people are starting to become aware of that. And the uncertainty in that is becoming a little bit less uncertain, I think, in a lot of people's minds. But here's the $64,000 question. Would an end to trade tensions necessarily abate inflation and recession fears? In other words, if we just go back to the status quo on tariffs, or let's say we end up in an even better place on tariffs than we were before President Trump took office, is everything fine? Well, I don't think so. And you're not going to be shocked to learn that I'm still bullish on gold, because no matter what happens with the trade war, there are significant unresolved issues in the economy. And I'm going to cover 3 of them today. If you're a regular listener to the show, this is not going to be anything shocking to you. I've talked about all of these issues on the show, but I thought it would be good to kind of put them together and give a 30,000 foot view of why I'm still bullish on gold. I don't think the gold bull run is over. I still think it's important to hold gold and silver in your portfolio. So let's start with de-dollarization, right? I've talked about de-dollarization a lot on the show. I think it is a trend that's not going away. I think that it's likely going to accelerate. I think even if, we resolve the trade war, I still think that the way it was waged has made a lot of people wary. And so what am I talking about here? Well, you probably know there's a growing movement around the world to diversify reserve assets away from the dollar. A combination of the weaponization of the dollar as a foreign policy tool, the aggressive sanctioning that the U.S. and the West did to Russia, locking them out of the SWIFT payment system. A lot of countries saw that. They're wary of that. Now, I'm not saying that that wasn't the right foreign policy move. That's a different debate. What I am saying is there's blowback from that. And people have watched that and they're concerned. They don't want to be able to be manipulated. And if another country controls your reserve assets, well, that's a problem, right? And then we have the U.S. government's fiscal mismanagement helping to drive this trend as well. And of course, I'm talking about the massive debt, the constant increase in the deficit, and the inability and unwillingness of Washington, D.C. to actually address the spending problem. And as I've talked about before, the dollar's share of global reserve currency, it's sliding, and it slid farther last year. As of the end of 2024, dollars made up about 57.8% of global reserves. That is the lowest level since 1994. It's a 7.3% decline over the last 10 years. In 2002, dollars accounted for about 72% of total global reserves. So you can see it shrinking. Obviously, 57.8%, that's still a lot of dollar reserves, right? So I'm not saying that the dollar is suddenly, we're going to wake up in the morning and all of a sudden, oh no, the dollar is no longer the reserve currency, financial collapse. No, I'm not saying that at all. What we're seeing is what a lot of people call a multipolarization of the financial system. We're seeing alternative payment systems. We're seeing transactions done in other currencies, euros, yuans. We're seeing gold have an increasing role. We're seeing the BRICS nations attempting to create possibly their own payment systems. So it's a diversification of the system that will not rely completely on dollars. Dollars are still going to be an important part of the global economy looking forward, but maybe a slightly less so. And as I've talked about before, that's still problematic for the U.S. government because we depend on the demand for dollars to prop up the profligate borrowing and spending, right? The money printing helps support the massive U.S. government. And if there is less demand for dollars, it's going to cause a lot of problems in the economy. And so we see the share of dollars in the reserves shrinking. And as this happens, gold is increasing. The yellow metal recently replaced the euro as the second largest global reserve asset. And it's not so much that the euro has declined, right? What we're seeing is the euro's remained relatively steady. Dollars have declined, gold has gone up, and now gold has knocked the euro out of second place as the global reserve asset mix goes. So this de-dollarization trend very much reflected in central bank gold buying, and that has been a major source for the recent gold bull market. And I've almost every analyst that I've talked to has mentioned this central bank gold buying as one of the major support pillars for the gold market right now. Central banks have gobbled up over 1,000 tons of gold for 3 straight years. And the fact of the matter is most central bankers think this buying trend is going to continue. Last year was the third largest expansion of central bank gold reserves on record. And 2022 was the all-time high. And this is the highest level of net purchases on record, dating back to the 1950s. And this includes the suspension of the dollar convertibility into gold in 1971. So what I'm saying is that this gold buying is unprecedented in the modern fiat currency era. I'll put it into some context for you. Central bank gold reserves increased by an average of only 473 tons annually between 2010 and 2021. So what we're seeing now is more than double what we saw as an average in the 20-teens, in the early 20s. So, as I mentioned, there's no indication that the central bank is going to stop adding gold anytime soon. We had a recent World Gold Council survey that came out. 95% of the 73 central bank respondents indicated they think central bank gold reserves are going to increase further over the next 12 months. And a record 43% of those respondents indicated they expect their own gold reserves to expand. That was almost double, up 29% from 2024. So reserve diversification will likely continue to support gold, and it may well accelerate as it becomes even more evident that the U.S. is unwilling to take the steps necessary to get its fiscal house in order. That's clear, right? So that's the first thing, de-dollarization. Second huge factor, inflation. Inflation's death has been greatly exaggerated. Despite cooling price inflation, as we see reflected in the CPI, monetary inflation, which is inflation properly defined, it's increasing, right? Keep in mind that price inflation, rising prices, is just one symptom of the increase in the supply of money and credit, which is what we used to mean by inflation. Money printing, expanding the money supply. And monetary inflation has been heating up for more than a year, right? During the pandemic, the M2 money supply surged by roughly $6 trillion as the Federal Reserve unleashed massive monetary stimulus. And that directly led to the bout of price inflation that we suffered through in 2022. During the Fed's inflation fight, the M2 money supply contracted. The Fed actually shrank its balance sheet in an effort to kind of wring some of that inflation out of the economy. This is exactly what needs to happen to get the inflation out. You've got to get all of that money that was created back out of the economy. So the money supply bottomed a little over a year ago at $20.6 trillion. And since then, it's been creeping upward. As of April, it was at $21.86 trillion. That's the highest level since June of 2022, and it's approaching the all-time high. Actually, it is beyond the all-time high that was hit in the spring of that year. So we're actually at the highest money supply we've ever seen. So eventually, this monetary expansion, inflation, is going to show up in rising consumer and asset prices. So that means investors still need to maintain an inflation hedge. And, it's also important to keep in mind, inflation isn't an accident, right? It's the policy. The Federal Reserve constantly devalues the dollar. The central bank isn't trying to end inflation. It just wants to keep it at a level that you don't notice, right? So monetary devaluation, your purchasing power shrinking, that's the plan. Wise investors should always be aware of the inflationary pressures in the economy, even when everybody claims inflation is dead because the CPI looks good, right? The bottom line is that while we do have a reprieve right now, as far as the prices go, inflation will almost certainly rear its ugly head again, with or without tariffs. In fact, the Fed never did enough to slay the inflation dragon to begin with. I think this is really important. I don't think a lot of people really have considered this, right? Paul Volcker showed us what a real inflation fight looks like. He hiked rates to 20% in 1980. Now, in today's economic environment, I don't think that level of hiking is necessary, but we certainly needed something more aggressive than a few months at 5.5%, given the nearly $5 trillion in inflation that was generated by quantitative easing alone just during the COVID era. That doesn't even account for the nearly $4 trillion in quantitative easing during the Great Recession that was never wrung out of the economy. Oh, and all of the easy money generated by more than a decade of 0% interest rates. But here we are. The Fed has already cut rates by a full 100 basis points, and despite some jibber-jabbering about inflation worries, the Fed is still expected to cut twice this year. That, ladies and gentlemen, is more inflation. So I've said this over and over again. The victory that the Fed is claiming over inflation means more inflation because they're going to return to the policies that got us into this situation in the first place. And this leads to the final issue, the recession threat. And I've been trying to hammer this point for months. Tariffs aren't the only reason to be concerned about a recession. In fact, I think tariffs are just one of many potential catalysts for an economic meltdown. It's like the economy is a candle looking for a match, right? Tariffs might be the match, or it might be something else, but there is a match out there that is going to light the candle. Most mainstream analysts seem to think the resolution of the tariff situation is going to prevent the economy from spinning into a recession. That's pretty much the messaging he got out of Citi. But we still haven't reckoned with the monetary malfeasance of the Great Recession and the pandemic, right? I've alluded to this when I talked about the inflation. After the 2008 financial crisis, the Fed launched an era of easy money that lasted basically 2 decades. And this resulted in a stimulus-fueled economic and market boom. That bust was already looming in 2018, and the central bank was forced to cut interest rates and relaunch quantitative easing in 2019. This is, I think, an often forgotten little era of monetary policy history, right? We had this big meltdown in the stock market. The economy was getting shaky. Powell stopped raising interest rates, started cutting. They went back to QE. It was an aborted attempt to normalize rate policy after the Great Recession. And this was a full year before COVID reared its ugly head. So the pandemic came and it gave the central bank and the federal government kind of a reprieve, right? It allowed them to double down on monetary and fiscal stimulus. They were able to kind of prop the economy back up again, but it just blew the boom bubble even bigger. Don't forget, every boom comes with a corresponding bust. And we haven't reckoned with the bust from the malfeasance after the Great Recession, much less the pandemic. We have 2 big stimulus periods, and we've not suffered from the bust yet. It's looming. It's going to happen. It's the normal cycle. It's the boom-bust cycle. You're going to go through the cycle because it is what it is. The U.S. economy is buried in debt. It's riddled with malinvestments. It's basically in bubble in search of a pin. And at some point, the bubble will pop and we will experience the inevitable bust. It's not just about tariffs. Just because we haven't suffered the consequences of this monetary malfeasance yet doesn't mean we won't. So keep in mind, the Federal Reserve started cutting rates in 2006, right? People were aware that there were problems in 2006. It took some 2 years for the collapse to finally manifest. And I know people sometimes will kind of come at me for being a perma-bear. And I kind of am a perma-bear because of the way the fiat monetary system works, right? It is designed to create a boom-bust cycle. You're always going to have it. And as investors, all we can do is reckon with it. And we've enjoyed the boom for a long time. We've enjoyed the boom longer than I think anybody who is in kind of my line of economic thinking thought. But just because something spreads out in time doesn't mean that the fundamentals are over. It doesn't mean the boom-bust cycle is over, right? There's no reason to think that. So when the bottom does fall out of the economy, the central bank is almost certainly going to try to reinflate the bubbles with rate cuts to zero, more quantitative easing. That's the fork it knows. That brings us back to the inflation issue. And it also underscores the fact that the Fed is currently stuck between a rock and a hard place. Another theme that if you listen to the show, you've heard over and over again, right? The Fed needs to keep interest rates higher to keep price inflation at bay. It also needs to cut rates to support the bubble economy. It can't do both. So while gold may see some selling pressure in the near term, wouldn't surprise me, some more corrections, some more consolidation. To me, these factors underlying the economy, the massive levels of debt, the inflation worries, the monetary malfeasance, all of these things support a mid to long-term bullish outlook for gold. And I think analysts at Citi, they're being a little bit short-sighted. They're missing these bigger pictures. They're not taking the full context. At least that's my opinion. You can take that for what it's worth. So before I close out the show, I want to touch on another issue that comes up from time to time, and that's the cost of storing gold and silver. And, there's some people that think it's a reason to spurn precious metals as an investment option. In fact, Idaho Governor Brad Little recently vetoed a bill that would have authorized the state to invest up to 7.5% of its quote, idle monies in physical gold or physical silver. Basically, in effect, the bill would have just created a process for the state to hold reserves of gold and silver along with its other investment assets. It'd be able to put some of those monies that are just sitting there in bank accounts in gold and silver to protect them from inflation and is one of the investment options on the table for the state. But anyway, Little vetoed it, and his stated objection was, quote, the many additional costs that will be borne by taxpayers for the storage, safeguard, and purchase of commodities such as gold or silver. Now, I happen to know that from an inside perspective, Little's veto had more to do with political power broking, and he basically doesn't like the people who are supporting the bill is the real reason he vetoed it. But this was his stated reason. So we'll address the stated reason and pretend like that's really really the reason that he vetoed the bill. Anyway, under current Idaho law, the treasurer is authorized already to hold cash as well as invest idle monies into U.S. bonds, treasury bills, interest-bearing notes, corporate bonds, money market funds. In other words, the state is allowed to invest in paper. And those paper assets not only come with counterparty risk, but also their yields tend to be below the rate of inflation. That's called a negative real return. So are Little's stated concerns about the cost of precious metal storage justified? I mean, how much does it actually cost to store gold and silver? I think it's worth discussing this because, it's a question I hear from folks out on the street from time to time. And of course, Little isn't wrong, right? Storage costs do exist, but they're not as high as you might think. And it's important to remember that there are costs associated with investing in any asset, including assets that are authorized under Idaho state law currently. Right? When individuals or entities invest in bonds or equities, they incur broker fees, commissions, account maintenance fees, etc. These costs can vary significantly depending on the broker, the size of the portfolio, and a lot of other factors. But in general, investors can expect to pay on average between 0.5% and 2% of the total assets under management in fees. So at the high end, an investor could lose as much as $2,000 annually to fees and other charges on a $100,000 portfolio. So, if Little's objection is just, well, there's some fees and costs involved in investing, well, then don't invest in anything, right? And if you read the veto message, you might get the impression that the storage fees for physical gold and silver are a lot higher than these other fees. They aren't. The annual average cost of vault storage can vary significantly, again, like fees, depending on the provider, the location of the vault, the specific services that are offered. But generally, the annual costs range between a little below 0.5% and 1.5% of the total value of the gold being stored. So, for example, the storage fees at Money Metals Exchange's state-of-the-art bullion depository out in Idaho typically runs less than 0.5%. In fact, right now, it's running at about 49 basis points. That means that the cost of storing $100,000 in gold is going to average you around $490 a year, right? This fee includes all risk insurance coverage for the full value of the metal stored in the vault. Money Metals' storage fee for gold and silver that's held in an IRA are even less at 0.29%. And it's likely that a major investor like the state of Idaho would enjoy lower storage fees, right, than the average investor. So while the cost of storing gold and silver, it's not zero, it's certainly not a bank breaker, right? This is especially true when you consider how much is lost due to inflation when you're just holding cash. Keep in mind, the current annual CPI is at 2.4%. Now, if you accept this data, and you shouldn't, because as we've talked about before, the numbers are cooked. The CPI is generally twice what they report. But let's just accept that 2.4%. It means the purchasing power of money sitting in Idaho's bank accounts is losing 2.4% of its purchasing power every single year. And when interest rates are low, the interest rates that are paid by banks to account holders often doesn't cover this monetary devaluation. Think about it. When the CPI was in the 9% range, real interest rates were deeply negative. Under those conditions, the state was effectively paying banks to hold its money. And this is why it's wise to have gold and silver on the table as an investment option to serve as an inflation hedge. As I've already talked about, price inflation is always stealing the value of the dollar. So think about this. In 2024, gold gained over 26%. The yellow metal edged out U.S. stocks to rank first among traditional asset classes last year. In other words, gold did better than all of those things that Idaho's allowed to invest in. And gold has increased another 26% so far. This is funny, and by funny, I mean kind of sad. An investigative journalist in Idaho published a report showing that Idaho lost out on more than $200 million just in the past year because the state can't own gold. The yellow metal has risen almost 50% since Little's veto. Now, he talks about having a fiduciary responsibility. Dude, not doing a very good job, right? The state of Idaho couldn't take care of these gains or couldn't take advantage of these gains because gold and silver are not investment options, and they can't be because Little is worried about less than 0.5% cost and storage fees. Meanwhile, the state's cash holdings are earning less than 2%, assuming a generous 4% return on a money market fund. So, nobody's suggesting that Idaho should put all of its funds into precious metals. It's not what this is. The bill was intended to expand the state's investment options and allow it to shield some of its assets from the pernicious and relentless effects of price inflation. After all, isn't one of the most oft-cited bit of financial advice to diversify one's holdings, right? Don't put all your eggs in one basket. That's all this bill was. It was an opportunity to diversify the state's investments, and Little refused to do it. Now, kind of looking at the bigger picture, investors always need to factor in various costs that are associated with a given investment option, right? Including storage fees for precious metals. It's absolutely fair to take that into consideration. And there may be times it doesn't make sense to hold a lot of gold and silver. And again, the bill in Idaho wasn't going to make anybody. They were perfectly welcome to sell gold during those times, right? But there are certainly times, such as the last 18 months, when you absolutely want gold and silver and you want a lot of it. Only a fool would take gold and silver completely off the table because of storage costs. So, all of that to say, I'm still bullish gold, no matter what Citibank says, because of the reasons outlined. And I would say that when we see selling pressure, and we probably will, at least in the near term, those are buying opportunities. Look at silver. When I started recording this morning, silver was back below $36 an ounce. I think that's a buying opportunity. I think silver is still drastically underpriced. Now, don't just listen to me. Do your own research. Look at your own situation. Consider your own investment strategies and your risk tolerances and all of those things, right? But precious metals should always be on the table. And I think especially in the world that we live in, a world that is ruled by easy money and debt, that means devaluation of your money every single day. You want to have real money. You want to have gold and silver. This is the perfect time to call 800-800-1865 and talk to a Money Metals precious metals specialist. They can help you figure out how precious metals will fit into your investment strategy. They can help you find the right product mix. They can tell you about storage in our state-of-the-art facility if that's something that you're interested in doing. So give them a call today, 800-800-1865, and talk to somebody today. If you don't like talking on the phone, I get that. Go to moneymetals.com. You can chat with the precious metals specialist online. You can ask questions there. Or if you just know that, hey, I want some, American Gold Eagles, you can just go to moneymetals.com and you can peruse all of our many products, specials, deals, everything's at the website, moneymetals.com. So with that, we're going to call it a wrap for this episode of the Money Metals Midweek Memo. You can get much more information about the things that I've talked about on the show and a lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you sign up and get on our email list. Of course, you can subscribe to the Midweek Memo on your favorite podcasting platform if you haven't done that already. And when you do, you'll also be able to listen to our Market Wrap podcast every Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and a lot of interesting people from out there in the world of gold and silver, economics, and investing. Thank you so much for taking a little bit of time out of your day to listen to the show. I know that you have a lot of choices out there. If you like the show, please do me one favor. Go to your podcasting platform, give us the 5-star review, say a few kind words, crush the like buttons, share the episodes, help grow the show. That's all we're asking, not charging you a thing. So if you could take that second, really would appreciate it. Thanks again for listening. We'll talk to you again next week.